Ladies and gentlemen, good day and welcome to Exicom Tele Q1 FY26 earnings conference call hosted by Monarch Networth Capital Limited. This conference call may contain forward-looking statements about the company which are based on beliefs, opinions and expectations of the company as on date of this call. The statements are not guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participants' lines will be in listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand over the conference to Mr. Rahul Dani from Monarch Networth Capital Limited. Thank you, and over to you.
Yeah, thank you, Pari. Good morning, everyone. On behalf of Monarch Networth Capital, it's a pleasure to host the senior management of Exicom Tele. We have with us Mr. Anant Nahata, Managing Director, CEO of the company. We have Mr. Siraj Khanna, CFO of the company. We will start the call with opening remarks from the management and then move to Q&A. Thank you, and over to you, sir.
Thank you, Rahul. So, good morning to esteemed investors, shareholders, and other stakeholders. This is Anant Nahata, CEO of the company. I'm also joined by our CFO, Siraj Khanna. So let me dive into the investor presentation which we had uploaded last night. And to begin with, the key message from our company is that we acknowledge this quarter's performance fell short of expectations. But at the same time, I would like to reiterate that this does not reflect our full potential as a company or the strong pipeline that we have today. We have the highest order book as we have ever had as a company. We have great momentum in EV charging business, which is building, which we'll talk about shortly. And we have a lot of big projects to deliver for, which unfortunately could not be delivered in Q1, but the deliveries are set to lift Q2 revenue contributions and henceforth. So, but overall, the quarter's performance has been short of expectations, but we still remain committed to the guidance that we provided for the full year. Tritium remains a strategic investment for global growth, though turnaround is lower than expected. But early signs of rising customer confidence and their ability to invest in our new product portfolio, the signs are encouraging. The key financials of quarter 1 FY26, I'll just say the highlights. Shiraz will discuss it in detail later. Revenue of about 151 crores on a standalone basis, adjusted EBITDA of 12.6 crores, and adjusted PAT of just about 1 crore on standalone basis. While we say adjusted because of an exceptional item for VRS of about 100 plus employees in one of our older facilities, which we are transitioning its production to our newer facilities. That's the adjusted exceptional item. On a consolidated basis, we did revenue of about 205 crores with adjusted EBITDA of minus 38 crores and adjusted PAT of minus 71 crores. This is primarily due to losses in our acquired subsidiary, Tritium. I'm going to skip the next 3-4 slides, which I hope you are familiar with. It talks about our company as a power management solutions company, which is a common thread between our critical power and EV charger business. It talks about our end-to-end portfolio in both these markets, via which we are able to serve entire telecom infrastructure requirement of power solutions and lithium batteries, and end-to-end requirement of EV charging solutions, whether it's a portable 3 kilowatt charger all the way to very high power 600 kilowatt fast chargers. I'll directly go to business update slide. So that's slide 12 for critical power. As you are aware, our business is highly dependent on growth of telecom infrastructure, particularly our critical power business division, which is largely represented by the number of new built towers, but also the back-end telecom infrastructure, maybe the MSCs, BSCs, cable landing stations, etc. Overall, new tower installations remain flattish compared to Q4 FY25 at about 7,500, and it was a 26% decline compared to Q1 of FY25. And that happens, as I've mentioned before, telecom infrastructure is a cyclical business. You see high growth in times of infrastructure investments, which typically happens with new technologies such as 4G, 5G, and hopefully, with 6G in future. And otherwise, what you have is a largely replacement business with some new business, which is the phase we are in right now. Our standalone critical power revenue was about 98 crores and consolidated was 102 crores. As I mentioned, this revenue is below expectations, but the primary reason for this was some of the key projects we are supplying to, including BharatNet, including a couple of other projects, including some large lithium-ion battery upgradation project. They had project level delays due to approvals, due to monsoons, and a lot of that has shifted to future quarters, particularly Q2. So you will see significant revenue contributions from the upcoming quarters. But on the positive side, we secured major wins from Middle East, from Africa, which is giving us hope for some of our best export business this year. We have a strong outlook given the order backlog, which is more than 1,500 crores. A lot of that is service in future years, but just the hardware supply orders also exceed about 1,200 crores. So slide 13 highlights in critical power business. The projects were delayed, but we did the entire solution development. The approvals are in place, and we could start execution for multiple customer accounts. We secured large orders from big telcos for lithium-ion batteries, and this space is undergoing a shift of rapid transformation where lithium-ion batteries are replacing traditional lead-acid batteries. We continued our dominance with almost 70% market share in one of the projects which was at its peak last year, but still continuing towards the back end of that project. That is setting up of infrastructure in rural and remote areas. We continued our dominance in that project, and we acquired some new customers, some new products. Highlight was also exports. Revenue from Africa and Southeast Asia contributed to 30% of our current quarter's revenue, and in these markets also we acquired new customers and also increased wallet share of existing customers. On the update on the EV charger business, this is slide 15. There are some great tailwinds in the EV charger business, and like critical power business is dependent on telecom towers, and similarly EV charger business is dependent on number of cars and electric cars and buses being sold. So in Q1 of 25 there were about 23,000 cars which were sold, which is almost 40,000 in Q1 FY26. That's a 15% growth compared to last quarter, 72% growth quarter on quarter. And that's because of new model launches, new premium SUV launches by major OEMs, Hyundai, Mahindra, the new models by Tata, and obviously everybody's anticipating Maruti's, launch, which is going to happen fairly soon. Under the electric bus segment, that's always been a vibrant sector, but due to payment security guarantees, a lot of OEMs were having challenges. The Indian government stepped in there, rolled out a payment security mechanism scheme, which enables states to faster deploy these electric buses. Because of that, we are seeing a lot of momentum in electric buses. Overall, Q1 is always, not the hottest quarter in automobile. The time around festive season, end of the calendar year is. But if you see our Q1 FY25 performance, we did on a standalone basis 33 crores versus which, this quarter we have done 61% more, which is about 53 crores in this quarter. That's roughly flattish compared to Q4 of FY25, and Q4 always is the time just around festive season. Just after that is the biggest quarter for us. On a consolidated basis, we did about 103 crores of revenue, which includes tritium and some revenue from Southeast Asia as well. Overall, we supplied more than 15,000 chargers, which would be by far industry leading compared to all our peers. Next slide is on policy, which we kind of covered. So I'm going to move to the next slide. So key developments for EV charger business. For the first time, we could make an entry into electric trucking segment. That's partly also because PM e-Drive policy allows for incentives for electric trucking, which was not the case before. And because of this, some truck makers are investing heavily to go electric. We secured some exclusive business with one of the largest electric trucking operator in the country. We also had an OEM win in the luxury car segment. This is one of the German luxury car automakers. They don't sell a lot, but that gives confidence on the value and the product quality that we have, where we are not just selected by leading Indian automakers, but by leading German automakers as well. We not just by tritium, but in regions of Asia, Southeast Asia, Middle East, we are doing a lot of effort to expand our business. And I'm happy to announce that for the first time, an Indian company has signed, which is Exicom. Your company has signed a global framework agreement with one of the largest clean energy players in Southeast Asia for EV chargers. A subsidiary of this company is putting charging networks in countries of Malaysia, Indonesia, and Thailand. And these are the main countries, but with a smaller footprint in some other countries. Exicom signed a global framework agreement with this company, and Exicom charger will go into all these countries. We also, we are also looking for growth opportunities via, new business model. We successfully have now commissioned and deployed our end-to-end turnkey business model, where we not only supply the charger, but do site construction, site surveys, installation, commissionings, and a lot of ancillary work around setting up a EV charging station. This has won us business from some leading OEMs in India, where the offering they are looking for is much more than charger supply. This allows us to create differentiation and also capture bigger part of their wallet as far as investment in EV infrastructure is concerned. We launched a new product. Every year we launch a new product, but this year we launched it with a lot of fanfare. There was a big event, and we used this to invite the entire Indian EV charger industry, be it the OEMs, be it the CPOs, be it the distributors, and took them through our new product, its feature, its differentiation. And that has helped us a lot. This product not only allows us to differentiate, but this event and subsequent sales effort have led to almost 6 of our top 10 customers switching to this product entirely. So this is the fastest scale up of a new product that we have seen at least compared to historically what we have done before. Digital enablement is also key part of our EV charger portfolio. So we continue to invest in a lot of digital platforms, particularly in platforms where we are able to monitor these chargers remotely and do a lot of things digitally to keep the uptime high, which is becoming one of the key differentiators amongst players in the industry. And also give customers a taste of some of these digital tools which allow them to operate and maintain their infrastructure in a better way. Next slide, slide 18, update on Tritium. As I mentioned, Tritium turnaround is taking longer than expected, but this is a strategic investment for global footprint, and we see some very positive leading indicators. That is, customer satisfaction in a lot of our services, our product, our reliability, and these scores were not high, when we acquired Tritium. We see order book building of the main center product of Tritium, where Tritium's product strategy is based off, which is the product known as Triflex. We have some orders in the bag, and we see pipeline continue to build for this product as we move forward. We had almost $8 million of booking in Q1 of FY26, including repeat orders, including service orders, but hopefully we can expand this much more rapidly than we have in the past. We are confident about some of our action, and that's why we are enabling Tritium to take some industry-first actions as well. For the first time in the world, Tritium announced this is industry-first, at least in the electric mobility industry, where we have introduced lifetime warranty on the power modules. When we consider DC charging, power modules are at heart of it. They constitute about 50% of the cost of the EV chargers, and that's the component which is prone to failure or can give you reliability if it works well. And Tritium introduced lifetime warranty for these modules, which is well received, and hopefully we'll see this message getting converted to pipeline and sales in the future quarters. Revenue by geography, with Tritium, we are a global company, so you see revenue distribution everywhere. We are an Indian company. The center of business will always be in India, and that is still more than 50% of our business, but some revenue coming up in every part of the world. It's really about scaling up this at this point. Next slide was Harmony Gen 2 and Tritium Triflex launch in India. I've covered this already, and here are some pictures for you to see. On the next slide, slide 21, there is general momentum, going across the business in EV charging. We have Spin Air going to customers through B2C channels. We won the award for excellence in EV charging by Nitin Gadkari. That's our CEO for EV business, receiving the award. There are a lot of customer testimonials of important stakeholders within the industry and some customers in general, praising their experience with EV chargers. A lot of my friends have this EV charger who are who quite like the product. So overall good momentum on the EV charging business. And the last thing I want to cover is Exicom's integrated manufacturing plant, which is under construction. Hopefully we'll be able to do SOP by October of this year. Just one second. Yeah, sorry. So, on the Hyderabad plant, this has developed into a stage where we can really see this as a plant. You see a lot of photos here, which means it's in advanced stages of construction. And we are really hoping that we'll be able to start the production here in late September, early October. This plant is something we're very proud of. It will represent not only one of the leading electronic plants in the country, but a lot of thinking behind automation, digitization, Industry 4.0 concepts, which will allow us to be a really high quality and lean cost manufacturer of our products. Last slide to be covered by me before I pass it to Shiraz, and then we'll be happy to take your question and answers. Deployment of IPO funds. IPO proceeds were roughly 400 crores. We have spent 257 crores till March of 25. Another 35 spent in Q1, and the balance as of 30th June is 108 crores. Majority of these funds will be utilized by end of September as the plant is in final stages of progress in construction. Working capital funds will see utilization in Q2. As I mentioned, a lot of the key projects, the revenue buildup will be from this quarter, and same with R&D expenses as well. So what we committed as the use of IPO proceeds is on track for deployment, and we'll hopefully see returns from those coming in the subsequent year. That I will thank everyone. I appreciate our patience with the company, and as I mentioned, we are in sectors which are high growth sectors. At least the EV charging sector is a high growth sector. On the telecom one, it's a stable sector with stable cash flows, though a little bit volatile in terms of revenue as it's project based. My ending remarks would be that I'm particularly excited by what we see in our pipeline, but what I see in our order book. Yes, there is a lot of work to do. There are challenges which we are trying to overcome, but the current quarter results does not reflect our potential and pipeline, and you will see we are a leader in the segments that we operate in, and we'll see that we hope to show you that even in the financial results in the coming quarters and years. Thank you. Passing to Shiraz.
Thank you, Anand, and good morning to everyone. Financials, Anand has already covered briefly, but I'll just go over the numbers again. Standalone revenue came down to about 51 crores, down by 29% quarter on quarter and 38% on year-on-year basis, primarily due to delays in the start of BharatNet project and some of the other projects, as Anand mentioned, as well as some of the deferrals that we've had in battery delivery, which will happen in quarter two. So, as Anand said, this will pick up in quarter two, the pace. Despite the softer top line, gross margin improved to 32.7% from 21.3% last quarter, which is a very healthy positive up, driven by a richer product mix, cost optimizations that we've done. Adjusted EBITDA also rose to 12.6 crores, which is 8.6% of the margin, up from about 10.9 crores in quarter four, reflecting a better operating leverage in EVSE segments. Adjusted PAT stood at 1.1 crores, about 0.7 of margin versus 4.6 crores in Q4. Moving on to consolidated basis, revenue was 205 crores. We had a pretty similar revenue in EV sector. We maintained it as what was in previous quarter. However, critical power was down because of the project start. So the quarter on quarter was down by on a consolidated basis by 23% and 19% year on year, reflecting a slower turnaround at Tritium along with domestic project delay. Gross margin remained healthy. We were at 39.4%, aided by high margin products that we sold and the geography mix that we got. Adjusted EBITDA was negative by 38.6 crores and compared to minus 17 crores in the previous quarter. And this primarily, of course, because of tritium operational cost, which continue to weigh on profitability of ours. Adjusted PAT was minus 71 crores, vis-a-vis 62 crores in the previous quarter. The adjustments that we've done, highlighted on the pages, is primarily because of the FX impact, which is more in terms of accounting than actual. And the VRS scheme and the redundancy schemes, VRS which we did, Anand mentioned in our standalone, and redundancies in tritium, where we were resizing our numbers of people out there. The EV business maintained a strong momentum year on year, particularly in Southeast Asia and premium OEM segments, while critical performance is expected to rebound in Q2 as different projects commencement has started. The company enters the Q2 with a robust order book, which Anand mentioned, and we anticipate improvement both in revenue and profitability. Moving on to, we recently completed a rights issue of 260 crores, which was successfully subscribed, rather a little oversubscribed on the rights issue. The breakup of the rights issue of 260 crores was that we were paying unsecured debts of 55 crores, repaying back that. This was the object of the rights issue. We were converting promoter given loan into equity of 107 crores. Investment in tritium to support it for a little more time before it turns around, 85 crores. And then balance 12 crores for corporate general purpose and issue expenses. So the overall holding of the promoters, which was pre-rights issue, was 69.5%, marginal dip to 66.5%, which is again healthy. The rights issue has been positive on our debt equity ratio as well. Pre-rights issue we were at 0.7%, and post-rights issue we are at 0.35%, which is giving us a high leverage, lesser pressure on the interest costs and so on and so forth. Our net worth pre-rights issue was 650 crores. Post with the 260 crores added, the post net worth has gone up to 910 crores. So that's the positive side. With that, I'll end my update on the financials. I'll hand it back to Anand for the Q&A session. Sorry, you can now take on questions, and Anand and myself will try and answer.
Okay. Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask question, may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Sahil Patani from Strokes Capital. Please go ahead.
Hi. So I wanted to understand that we are still maintaining a guidance of 100% revenue growth over FY25. And since we've done about 200 odd crores in quarter one, that leaves us about room for 1,500 crores to be done for the remaining 3 quarters. So if you can list down the factors that, that's contributing to us being still confident on achieving that kind of growth for the remaining 9 months of the year. That's my first question.
Well, so I think the guidance was 50% growth in revenue and EBITDA on a standalone basis, not 100%.
On a consolidated basis, I think.
So we had given a guidance of for 50% increase in the revenue and 2.5x of the EBITDA, and that guidance still holds good. We are confident that for the remaining 9 months, we'll be able to hold on to the guidance.
Right. And I just wanted to understand that in terms of project execution or orders, like, if you can just list a couple of factors that is helping us to kind of maintain that guidance, like what is contributing to that?
Yeah. So I'll first talk about the standalone basis. So a lot of the today's what I spoke about in the presentation, and even from a perspective of when we gave out that guidance, is really backed by in the critical power segment by the order book that we already have. So I wouldn't say 100%, but a lot of it is backed by the order book that we have, and some proportion is based on business as usual, where we keep getting run rate business, etc. And we feel pretty strongly about it. As I mentioned, the quarter one revenue was more on accounts of project delays. And when I say project delays, it may be due to customers, it may be due to product approval, it may be just the paperwork concerning the project. A lot of these, and not just one project, but multiple projects that happen. Sometimes just luck doesn't work your way. And all of those are solved, and the projects have been put into execution mode in the last quarter. We may not have had huge revenue from it, may have had single-digit growth revenue, but the execution has started. So that gives us confidence that we'll be able to sustain that guidance through remainder of the quarters, because the capacities that we have, especially after Hyderabad, that will come up in October, will not be deterrent in from a revenue perspective to be able to recognize by the company. And mathematically, that guidance converts into 4x EBITDA on a standalone basis of what we did last year. So we hold to that. On a consolidated basis, I think we gave a guidance of 100% revenue growth. This is something broadly will maintain, but as Tritium is taking a little longer to turn around, there may be some shortfall in the consolidated revenue guidance, but on a standalone basis, we continue to maintain the guidance.
Okay, that helps. The second question is around profitability. Obviously, this has been our fourth quarter consecutive where we posted losses. So when do you think eventually we'll be turning profitable? Would it still be within FY26, or you think because of Tritium we might slip into FY27 as well in terms of profitability?
Yeah. So on a standalone basis, even with this very low revenue figure, we were still PAT positive. And if we have to scale up the revenue, as we have already spoken about, that will definitely propel profitability, because with low revenue, the fixed cost coverage, variable cost coverage is quite low. So and that's where some of the guidance of 4x EBITDA, etc., is coming from. On a consolidated basis, I think profitability guidance will only be for FY27, not for FY26, on a consolidated basis.
Okay. That's it for me. Thank you and good luck.
Thank you. The next question is from the line of Samrat Chadha from Prosperity Wealth Advisors. Please go ahead.
Hi, good morning. Hope I'm audible.
Yes.
Yeah, okay. So the Harmony Gen 2 and Tritium Triflex chargers, we have received a very strong market response. What is the expected gross margin for these new products, and what is the current order backlog outlook?
Yeah. So, Tritium Triflex, because it's part of the portfolio we launched, that's a very high-end technology, with main markets being U.S. and Europe. In India, there is no, I wouldn't say there is an immediate market for it, but there is activities on business development, et cetera, which are taking place, and they'll be really fruitful when we have, really high energy battery cars and big trucks and big buses, all of them requiring 10 to 20 minute charging. So these are very advanced liquid cooled chargers, which will eventually come to India, but today it's in the business development phase. But the main launch, etc., was for our Generation 2 product, which we call as Harmony Gen 2. I can't give you exact specific numbers, but this is the first time where we have been able to give a better value product in terms of features, more things, better aesthetics, better durability, and increase our gross margin at the same time. Usually that doesn't happen, but this time we have been able to do that, and that's where you want to be, right? Where you're able to give 2x more value and earn like 1-2% more. But our gross margins in EV charger business are in line with our expectations. That's what I can tell you, even though it's a very fierce competitive market, right? It's a new segment, and every time there is something new, businesses in India go through this period of phase where 20 people are trying to do it. But I think we have been able to convince the customers of the value that we bring. Not all the customers, some we have not been able to convince and we lose them, but most of the customers who are deploying charging networks, who have funds and investments to deploy charging networks, I think we would have majority share in it. So can't give the specific margin, but but it's in line with our expectation and better than what we had in the previous product portfolio. That's one. You asked in terms of pipeline. Again, our 50% of the business, and this is not an exact number, just a directional number. Almost 50% of our business comes from AC chargers, and about 50% of the business comes from DC chargers. That entire pipeline of DC business, as we are in the transition phase, converting customers to Gen 2, but I would say on an ongoing basis, more than 50% of the deliveries of DC chargers have already converted to G2, and by end of the year, I think it will be 100%.
Okay.
Being able to convert maybe is some related to some government specifications, etc., where we may have approval for the older product and the newer approval will take time, things like that, right? But I think for our practical purposes, we have already converted everything to G2, whatever is left by end of the year.
Okay, great. And our Hyderabad plant would be operational when, totally?
So we're going to start operations in October. You saw some pictures in the presentation. They're at very advanced stage. We're going to start
October this year.
October this year, but that does not mean it will, be at full production in October. So October it will start this year, October 2025, and then there will be a period of 2 quarters where the complete transition will happen, right? So product by product, line by line, etc.
Okay.
Sorry to interrupt.
One of the questions.
Sorry to interrupt. We would request you to come back for the follow-up question.
Okay, I will come. Sure.
Thank you so
Thank
much.
you.
The next question is from the line of Shashikant from Mind Equity Advisors. Please go ahead.
Yeah. Good morning. So my question is extending the previous participant's question. So on Hyderabad plant, what capacity utilization we are expecting to reach in the next 2 quarters after the commissioning?
So that today we are operating at a very high utilization, specifically in Q2 in our current plant. In the Hyderabad plant, the overall capacity that we can cater to is a lot more, right? Because that's a plant we have built for future. So today we are not utilizing all the space and the capacities that we are building. So plant and machinery is modular, being put for our let's say next 2 years requirement, right? And if we want to expand the space to expand more. So with the current plant and machinery that we are putting, our utilization will absolutely be north of 70 to 75%.
So my second question is, so what's our, view on the EV industry this year for FY26? What kind of growth we are seeing? And secondly, what kind of, tower additions we are seeing in this financial year, FY26?
Right. So I'll answer the EV things first. Though I've been excited by EV industry all the years since we have gotten into it since 2019, but even within those 6 exciting years, there have been 2 years I've been very excited. One was FY23, so calendar 22 FY23, where we saw this thing amongst most of the players that everything is going to turn EV. Let's invest in EV. Let's not miss the bus. So that was excitement out of a little bit fear, a little bit about future technology. And today, the tailwinds I'm seeing in this industry far exceeds anything that I've seen in past. And this excitement is out of people's comfort with EV, the people understanding the TCO, people adopting EVs as the first car, government being hell-bent sure on making electric buses a norm. For the first time, people acknowledging that heavy vehicles, which may be large trucks and buses, can go EV. Earlier, never people promoted कि EV तो खाली गाड़ियों के लिए या scooters के लिए, it's not for buses and trucks. But today that's not the case. So, and more importantly, the companies who matter in India to the Indian population, whether it's Mahindra, Maruti, Tata, all of them coming out with models in EV with very big investments around EV, right? So, all that has created tailwinds for us, which has created exciting pipeline for us and for our peers as well. And overall, I think on a slide I showed you the car growth of passenger vehicles. That is roughly, quarter on quarter, like in a sense, last year quarter versus this is 70%. Even Q4 versus this quarter is 15%. So all that means charges will be required, and companies like us, or for that matter any other company in the electric mobility ecosystem, should gain on top of it. Yes, it's going through very intense competition. Prices have fallen way beyond what we would have expected. But as I mentioned in the previous question, as Exicom, we believe in giving great value to the customers. And by doing that, yes, there has been margin compression, I won't lie, but if we're still maintaining, let's say, in my opinion, industry-leading margins compared to our peers.
Okay. Thank you for patiently answering the questions. Thank you. Good day.
Thank you. Before we take the next question, we would like to remind participants you may press star and 1 to ask a question. The next question is from the line of Sagar Gupia from Union Bank of India. Please go ahead.
Hello. Good morning, sir.
Good morning.
Hello. Sir, I have just one question that due to geopolitical factors, there are challenges in importing rare earth materials from China. How is this affecting Exicom and the electric vehicle industry, and what measures is Exicom taking to address these challenges?
Yes. So, this rare earth metal and magnets, so first of all, they have wide variety of use, no doubt about it, right? So it impacts everyone, including us, and I'll just come to that. But we don't use these type of products in the way automobiles or some of these companies use, right? We don't use them. So the proportion of effect on us is a factor of what auto companies go through. So I just want you to note that. If we buy, for example, 100 components or 1,000 components, out of 1,000, maybe 5 or 10 components use that, and we have seen delays in those components availability. But it's delays in those availability, not that they're not available or we have to reshape our production entirely. So for one of our charger categories, for example, last month production was 80% of what we expected because of delay in these materials. But on an overall, year basis, quarter basis, I don't think the impact will be significant, which will make a difference in numbers for us. So yes, realistically, we have to work harder. There is some impact on a minority number of components, but it's not an impact where we would, which would lead us to change our guidance or explain it, or have like a significant explanation to shareholders.
But sir, due to this EV car sales growth is declining as the cost is affecting, then do you think that this cost will also affect the EV charger industry?
Yeah, so that's a very good question. So while 3 months ago there were talks of people cutting down production, etc., but from whatever forecast we have seen, it doesn't look like to be the case. And I read in the media, same as you do, it looks like India-China relations are improving. So again, I don't know what's happening at that level, but we have not seen any severe cut down in production by any of the big OEMs. At least I've not seen any big public announcements in that regard. So hopefully that's not the case.
But sir, despite having an advantage in domestic charging and acquiring tritium, our revenue continues to decrease while company expenses rise, and our competitors like Servotech, who are relatively new to this field compared to Exicom, and are demonstrating better result and growth with their investors and experiencing, if I'm saying, like significant returns over the past 5 years. Given this circumstance, why is Exicom unable to achieve, sir?
Yeah. So again, on the Servotech, from what I know, they're a player in multiple domains: EV charging, solar, EPC of solar. So I'm not sure if the EV charging business is bigger or higher growth than us. As a full company, I'm not sure because they're engaged in multiple businesses that I know. So I would just advise to compare Apple versus Apple. That's a company much more focused on government business, which is good, but if we have limited capacity, we try to do business which best serves as the return for those capacity. And at current pricing, it wasn't the PSU business in past. In future, it may be because government has now strengthened the PMP norms, which allow people like us to compete better versus the norms in the past. So, but to my best of knowledge, I think from a customer perspective and revenue perspective, at least in EV charging, we would, on a continuous basis, we would be the largest provider out there. Now, if someone's revenue are a lot bigger due to 1 or 2 tenders for 1 year, I can't say, but on a continual steady state basis, I think we are the largest EV charging company in India.
Okay. Like, sir, I just want to know one thing.
Sorry to interrupt. We would request you to come back for a follow-up question. There are several participants waiting.
Okay, ma'am. Thank you.
Thank you so much. The next question is from the line of Samrat Jadhav from Prosperity Wealth Advisors. Please go ahead.
Hi. My question is on R&D. Our R&D, how is our R&D budget allocated between critical power, EVSE, and emerging technologies like DC microgrid solutions? Or do you have any upcoming innovations which you can highlight?
Yeah. So R&D is, I'll just tell you the percentage, but it's a substantial percentage of our budget, and most of our products are in-house designed, right? Just even before I go in the budget allocation and everything, we'll have about, I think, close to 160 people in R&D, almost evenly split between EV charging and critical power. And the type of stuff we do, like, today, the heart of EV charger is the controller, right? Like in any product, the CPU of the charger, the controller. We are the only Indian company designing and manufacturing that in India. There is no other charger OEM who has its own controller. Again, it provides that flexibility, gives customer more confidence in longer term. So we try to differentiate ourselves in R&D by going much deeper in technology development than what other peers are doing. So the breadth of technology development we are doing in EV charger differs in two ways from our peers. We are the only company from portable charger to high power charger. We have the entire product portfolio. So otherwise, some of our competition is just focused on government. Some competition is just focused on bus charger. Some competition is just focused on public charging. Somebody just in home charging. But we have the entire breadth of portfolio for not a very expensive. So our expense of R&D as a cost of sales would be between 3 and 5%, and not exactly equal, but broadly, EV charging would be, let's say, 60% of the expense. Critical power would be 40% of the expense. Again, directionally, don't hold me for the exact numbers, but
okay,
it's exact numbers.
Around basically.
Yeah.
Okay. And any upcoming innovations which you can highlight?
In fact, you said it. So we are continuously working on incremental innovations. So we work on two types of innovations. One is incremental innovation, which is more feature, taking away some pain of the customers, improving the customer experience. And sometimes we work on path-breaking solutions. So, a DC, a solution for EV charging, high power EV charging, where the grid is not supporting such high power, right? So a battery, an integration of battery energy storage system and EV charging is something we are looking at. We did have a pilot product last year in that, but with all those learnings, etc., scaling up of that. So it's similar to a DC microgrid, but in some nuances. So the answer is maybe not as a product, but as a solution, we are looking at something quite novel to enable high power charging for high energy vehicles.
Okay. Thank you very much.
Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference to management for closing comments.
So I really appreciate everyone taking time and interacting with us. If you have any other questions, feel free to email our investor relations. We'll try our best to reach out to you. We want to be transparent. We appreciate your journey as shareholders, investors in our company till now, and we are trying, myself and my team are trying our best to meet the guidance provided by the company this year. We are excited about the business. Though quarter one results may not reflect exactly the same, but hopefully you'll see that excitement coming to fruition in the coming quarters. So thank you, everyone.
Thank you. On behalf of Monarch Networth Capital Limited concludes this conference. Thank you for joining us, and you may now disconnect your line.
Thank you.